When we talk about stock market, a general conception is that it's a place where traders and investors meet, and often investors make profit and suffer loss too. Well, yes, the stock market is a place to create a huge wealth in the long run despite the volatility of the market. But often many investors lose their money due to some common mistakes that can be easily avoided. So through this video, we'll talk about some of the top mistakes that you can avoid in the stock market. The sole reason behind investing in stock market should be to fulfill your goals. But if you're investing without a plan or goal, you aren't investing at all. Why I say that is because you're jumping into the market without a clear understanding of your investment goals, risk tolerance, or time horizon. As a result, what will happen is that you will end up making impulsive decisions driven by emotions rather than sticking to a well-defined strategy. Another mistake that investors often make is that they focus too much on short-term gains, because of which they make hasty decisions. What happens next is that they chase after the latest hot stock or trend without even considering the long-term prospects of the company. But what should be done instead is that you should focus on long-term investing and consider the fundamentals of the companies you're investing in. Not diversifying your portfolio is another big mistake. Because when you invest in a single stock or sector, it only exposes you to the performance of that one investment. And if that investment performs poorly, then your entire portfolio suffers. Initially, when we first start investing, we tend to follow the herd mentality. That is, investing in stocks solely because others are doing so. But let me warn you, doing so can lead to poor outcomes. Hence, it is important to evaluate each investment opportunity based on its own merits and not just follow the crowd. Investing in stocks solely on the basis of their recent performance can be dangerous. So it's always suggested to evaluate a stock's long-term potential rather than just focusing on its recent performance. Lastly, overtrading could be bad for your investment goals. Well, trading too frequently can lead to high transaction costs and taxes, which can eat into an investor's returns. Therefore, it is important to have a disciplined approach to investing and avoid excessive trading. That's all for now in this video.